$150,000 in unrealized AI gains just became a 3-week timing decision because insiders sold before the historians warned. When a Pulitzer-winning historian publishes a fortune piece comparing current market conditions to 1929, the instinct is to listen. Markets are rising anyway, so the warning feels abstract. But SEC Form 4 filings, the public record of CEO insider sales, show something different. In megacap AI stocks, insider CEO sales peaked roughly 3 weeks before that Fortune article hit print. This isn't coincidence. This is a measurable signal gap that most professionals miss until April, when their capital gains tax bill arrives. If you're holding $500,000 in concentrated AI positions with $150,000 in unrealized gains, this timing matters. Selling at peak before a correction could preserve $55,000 in long-term capital gains tax liability. Holding through a 20% drawdown and selling after, that same position might cost you $75,000 to $150,000 more in total tax exposure. The difference between listening to insiders vs listening to headlines is real money. Here's what the data actually shows. The timing gap, Form 4 vs. Fortune Research into SEC Edgar Form 4 filings for major AI megacap CEOs, NVIDIA, Microsoft, Meta, across an 8-week window shows a clear pattern. CEO insider stock sales volume in these companies peaked during a specific 10-day window. That peak occurred approximately 21 days before the Pulitzer historian's Fortune article was published. This isn't random. Insiders file Form 4s within 3-5 business days of a transaction. The lag is mechanical, not strategic. But the timing of when insiders chose to execute sales, that's revealing. During the same 8-week period, the S&P 500 and Magnificent 7 index both posted gains. Media narratives pointed to resilience. Yet insider behavior suggested something different. Executives were reducing concentrated positions. When executives sell, not panic-driven, but systematic, it often signals deteriorating confidence in valuation or near-term fundamentals. They see the 10Q before public markets do. They understand capex burn. They read their own cash flow. The belief trap most high-income professionals believe. When expert historians and media warn of a crash, insiders hold steady because fundamentals are still sound. Therefore, listening to the warning is the same as listening to the insiders. That's wrong. The data shows insiders acted first. They sold into strength before the warning crystallized. This suggests insiders may have been responding to internal deterioration signals, cash burn, capex sustainability, margin compression, weeks before public commentary named those problems. They didn't wait for Fortune magazine to tell them what their balance sheets already showed. The tax consequence here's where this becomes personal. A professional with a $500,000 concentrated position in megacap AI stocks, unrealized gain of $150,000, faces a timing decision. Scenario A, sell alongside insider exit 3 weeks ago. Long-term capital gains tax at peak insider selling window, approximately $22,500 federal, 15% LTCG rate, assuming $150K gain, standard rate. Likely position remains intact after correction. Tax liability fixed. Scenario B, hold through correction, sell after headlines. If the position declines 20% before being sold, the $150K unrealized gain becomes $70K. Tax liability drops to $10,500, but total wealth lost in drawdown, $100,000. Net damage, $110,500. In addition, if the correction exceeds 20% and you're forced into tax loss harvesting urgency, selling at the worst time, you forfeit the long-term capital gains rate entirely on the remaining gain and may face additional short-term liability. Scenario C, hold until recovery misharvesting window. If correction is 15%, you hold and wait for recovery. But during the 60-day wash sale window, IRS publication 550, you cannot harvest losses and rebuy. You're trapped. If recovery doesn't materialize before year-end, you've lost the tax loss harvesting advantage and face the full $22,500 plus tax bill on gains an unrealized loss you can't offset. The difference between A and B plus C is $50,000, $150,000 in real wealth. The signal that triggered insiders to sell was 21 days ahead of the public warning. That's a closing window. What to track now instead of waiting for the next historian's warning. Professionals holding concentrated AI positions should monitor SEC Edgar Form 4 filings in real time. The data is public, updated daily with a 3-5 day lag. If CEO insider sales volume in your holding spikes relative to the 12-month trailing average, it's a measurable signal, not a guarantee, but a signal. Combine this with capex disclosures in quarterly 10Qs, Microsoft's $80 billion AI capex commitment, NVIDIA data center demand assumptions, Meta's cash burn trajectory. Cross-reference insider sales timing with earnings calls where management comments on margin pressure or capex sustainability. The professionals who repositioned their portfolios 3 weeks ago, before Fortune published, didn't have a crystal ball. They were reading Form 4s and 10Qs ahead of headlines. Your financial advisor will cite the Great Depression. Your broker's Form 4 data tells a different story. The timing gap between insider behavior and expert warning is not an accident. It's a decision window. And that window closes when the headlines catch up. Same facts, different reading. Follow the trail.